In this video, we will be looking at portfolio optimization in Solver. This is really a killer application in finance and business analytics. Every year, trillions of dollars are traded using portfolio optimization techniques. And if you have a mutual fund or ETF or something like that, there is a portfolio optimization engine behind it, which constructs it. Okay, so what we'll be doing, just to go through the outline, we'll talk about data first. I'm a statistician. I love data. And this application is great because it combines data with financial theory, with optimization, with information technology, all the elements of fintech. And so look at the data. And what's great about this is there's lots of sources for the data. And we'll be looking at finance.yahoo, and you can actually download your data from there if you want to. A little bit about basic finance. Then we'll look at the portfolio returns and then take a look at the model and solver. Okay, so one way to get the data is you can go to finance.yahoo.com and you can click historical data and use your adjusted monthly close. If you're looking at a stock price or an index, you compute a return for each month, right? You have the price, but we want returns, so it's a very simple equation for computing returns. We're also looking at T-bills, okay, which are 13-week US Treasuries. That's a very important concept in finance, is something called the risk-free rate, and often T-bills are used for that. Its ticker is IRX. Don't ask me why, I have no idea. Now, finance.yahoo reports a yearly rate, okay, a yearly yield for T-bills. And we have to convert that to monthly yield because all of the data we're looking at is monthly. And so you think, oh, I just take the yearly divided by 12. That's kind of incorrect. If you're thinking about rates of return, there's a little bit more complex formula than that. They tend to be very similar, but a little bit different. And so I just pulled down some assets just to get some diversification. T-bills. Back when I did this, AUX was a gold index, but I think now it's something else. And some normal things, some places where my family spends money. Things like Apple and Detroit Edison. Up here in Michigan, our utilities, Detroit Edison, and I just love electricity. I love Detroit Edison. Comcast, General Electric, Google, Pfizer, ExxonMobil, Whole Foods, some of the typical large cap companies. Okay, and here's the percent return. So I pulled down the data from finance.yahoo. And we have the T-bills. Look, the T-bills are extremely small during this time period. So this was 2007 to 2010. I'm kind of blocking it here. All right. So this includes the great financial collapse of 2009. Okay. So the returns are kind of muted because of that. And you can see that the returns for T-bill are very small and consistent over time. If you do this and your T-bill returns are big, with big swings and big positive numbers and big negative numbers, then you did a mistake. Okay. And if you look at, wow, like Apple in 1 month went up by 23% in October 2017, and it went down by 32%, right? So when you look at monthly data, you have these big swings, and you have Citibank here. Wow, during the financial collapse, they went down by 46%, 47%. And then after TARP came out and they got recapitalized, their returns went up by 68%. So you see these big swings in monthly returns. All right. Well, the basic principle in finance is if a stock is really risky, for people to invest in it, you're going to have to offer them a bigger return. So if it's really risky, you got a big return. Typically, if it's not risky at all, something like a utility, like Detroit Edison, then the return is going to be small. Okay. Now, a common measure of risk is the standard deviation or the variance, right? So if you take the standard deviation and square it, you get the variance. Or actually how it's computed, you first compute the variance and then you take the square root to get the standard deviation. Okay, so if a asset has a standard deviation of 0, it means it's risk-free, right? You know exactly what it's going to be in the future. It's like a fixed income investment. And typically in finance, we use T-bills for that, 13-week treasuries, because we don't anticipate the U.S. government going bankrupt in the next 13 weeks. Okay. Now, these days, in the current politics, who knows? Maybe U.S. government will go bankrupt at some point. And also over a 13-week period, you'd expect, well, inflation's not a factor, right? So if inflation's not a factor, I'm pretty confident that if I make an investment in T-bills in 13 weeks, I will get out money at that particular interest rate. Now, big standard deviations mean you just don't know what's going to happen in the future, right? And the bigger the standard deviation, the less sure you are about what the behavior will be in a future time period. Okay, so this is just looking at that financial theory. And what we have here is I just sorted the stocks by its risk. So I have the average risk and average standard deviation. I'm sorry, the average risk and average return, mean return, and standard deviation. And I sorted by the standard deviation. So T-bills here has a smallest standard deviation, right? Risk-free rate. And so the risk-free rate of return is 0.08% a month, right? These are monthly percentages. Next is ExxonMobil, and the return is actually negative, right? That's not a good thing. If you knew that, you probably would not have invested in ExxonMobil. So that would be inefficient. I'd rather have a T-bill than ExxonMobil. I'd rather have a little bit of a return than a negative return. Next one up is Procter & Gamble. And compared to T-bills, the risk went up, right, from 0.1 to 5% risk a month. But the return went up too, right? The return went up. These are all in percentages, so that's 0.25% return. At least it's somewhat positive. New York Stock Exchange went down, so that's inefficient. You would not invest in the New York Stock Exchange, the overall index, if you knew that. Detroit Edison is good, right? Compared to Procter & Gamble, it went from 5.5% risk to 6.62% risk. Risk went up a bit, but also the return went up a bit, right? So that's a good thing. Same thing for Pfizer. Toyota Motor, nope, risk went up, but return went down. So that's inefficient. And so all these in yellow are inefficient. And Amazon, okay, we all love Amazon, especially if you're a shut-in. The risk went up to 12%, almost twice what Pfizer is, but the return went up by a bit, right? So that's a good thing. Apple, the return almost doubles over Amazon. Everything else is inefficient. And then down here, Ford, hey, go Ford. That's, for me, a local company. And had a good time during this time period. The return was 3.7%, which is about the maximum that we see here, but the risk was very high, to 28%. Okay, so we can plot this. So I plot the standard deviation on the x-axis and the return on the y-axis, and this is my risk-return trade-off. And you can see here that if you want a small risk, you'd go with T-bills, but you don't make much money. If you want a big risk, you can go with Ford and you make a lot more money. Or Apple, if you would have done Apple and Amazon just held, you'd be very wealthy right now. Didn't have Tesla in here either. Okay, so where do you want to be on this graph, right? If you had a choice, where would you want to be? Do you want, a big risk and a small return, or do you want a big risk, big return, or small risk, big return, so on? Well, yeah, you want to be in the northwest corner. All right, typically, if you're risk adverse, you don't like risk, but you do like more money than less money. So yeah, you want a big return and little risk. All right, so if you take a look and say, hey, I have a risk tolerance of about 10%, right? Just getting to that point to saying what your risk tolerance is, risk tolerance of 10%. What would you invest in? Well, you come down here and say, well, here's 10%, and probably these stocks around here, right? So, okay, yeah, gonna be making just about 0% return, okay, or just slightly below the mean. Okay, so the big question is, how can we reduce risk because we don't like it, but still get a big return because we do like a big return, right? That's the huge question. And Harry Markowitz gave us an answer. I just love this picture of Harry. He's a very friendly looking guy. And he came up with portfolio optimization. Basically, the whole concept that diversification of risk is a good thing to do. So if you can diversify, you reduce your risk through diversification. Okay. And he won the Nobel Prize for that in economics in 1990. All right. So before Markowitz, the idea was, hey, you find a few stocks that you like, you invest in them and hold them. Markowitz came around and changed the whole financial industry. Right? He said, well, you can diversify, and you just don't diversify willy-nilly. You can do better than just willy-nilly diversification, but you can be very strategic in your diversification. And if you do that, you can maximize your return for a given level of risk. He had a couple collaborators. I knew someone who talked to Harry once, and Harry was very generous and said, yeah, he talked about these things with Jimmy Savage, who is also at the University of Chicago. And Jimmy Savage really is a genius statistician. I'm very kind of related to Jimmy Savage because I'm a Bayesian statistician, and Jimmy Savage is a great Bayesian statistician. And my own PhD advisor, Bruce Hill, spent the same time with Jimmy Savage at U of M. Right? And so my advisor, Bruce Hill, learned his Bayesian statistics from Jimmy Savage. So that was great. I feel a connection, three-way, thrice removed, I guess. And he also worked with George Danzig at the Rand Corporation. George Danzig came up with the simplex algorithm for linear programming, which was a huge contribution. He also got a master's of math from University of Michigan, which you can see in the background. I have some big block M flags. Don't hate me for it. But there you go. Okay, a little bit of background is just linear combinations. That if X and Y are random variables, which means kind of like stock returns are random, we don't know what's going to happen. They have distributions, and you make a linear combination AX plus BY is equal to Z. You say, well, okay, what's the mean of Z? Well, it's very simple. The mean of Z is A times the mean of X plus B times the mean of Y. Okay, so we're saying, hey, we fix A and B, and we wonder what Z will be. Okay. The variance is much more complex. It's a quadratic function, okay? And so the variance of Z is A squared variance of X plus B squared variance of Y. And then we have a little bit at the end that depends on the correlation. 2 times A times B times standard deviation of X, standard deviation of Y times the correlation, okay? So, and that's how you get the variance of Z. So let's take a look at a portfolio example where we have two stocks. X is stock 1, Y is stock 2, and we're investing in X and Y to get Z out. And so here's two stocks, Intel and Pfizer. And the mean of Intel is 0.045% a year. The mean of Pfizer is 1.182% a year. And then they have the risk here is the standard deviation, 8.6 and 6.9, and the correlation is negative. Okay, if you can find negative correlations in your data, that is fantastic for portfolio optimization and for diversification. That means when Intel tends to be up, Pfizer tends to be down, and vice versa. If Pfizer tends to be up by a little bit, then Intel tends to be down by a little bit. And so the mean return, if we put 20% of our investment into Intel and 80% into Pfizer, then the mean is just 0.2 times the mean of Intel plus 0.8 times the mean of Pfizer for the mean of 9.54. So that's kind of good. This is just a weighted average. So taking a weighted average will put it right between the two numbers, right? The more I put into Pfizer, the closer I can get to 1.182. The more I put into Intel, the closer I get to 0.045. But where the magic really happens is with the risk, right? So it's a big equation for the risk. But you 0.2 into Intel, 0.8 into Pfizer, and we have this correlation term at the end. Right, there's where the correlation. And it's a risk, so I take the square root of the variance. And this is way exciting. And ask yourself, why is this so exciting? What is it about this? Right? Really tedious little computation to do by hand or in Excel, but it's way exciting. Okay. You should be jumping out of your chair by now. And the reason it's exciting is the risk for the portfolio is less than the risk for Intel or the risk for Pfizer. So we have a smaller risk by diversification. So the mean's going to be between the two means, but we can actually get the risk less than the risk of the two. Okay? And we can plot that. So if we take a look at the risk axis and then the mean return axis, and Intel is in red and Pfizer is in green. And by varying the weights between 0 and 1, right? The weight for Intel is between 0 and 1, and the weight for Pfizer would be 1 minus the weight for Intel. We can trace out this curve. So we can make, by doing the diversification, varying that weight, we can get everything, all the mean variance, mean and risk characteristics between the green square and the red square. Okay. So if you say, hey, my risk is 5%, here's Intel has bigger risk, Pfizer has bigger risk, right? This is Pfizer up here. And you can get a portfolio that's right there with a bigger mean. Okay. So that's fantastic. This is if you make the investment going long, right? You actually put money into Intel, 20% into Intel, 80% in Pfizer, something like that. If you go short, you can really have fun, right? Shorting is where we arrange with your stockbroker. He will give you Intel stock. You sell it. You take the proceeds and you put it into Pfizer. That's how you can short Intel, and you can use that to leverage your Pfizer. And when you do that, you can get everything along this green line. Okay, so if you're very high risk tolerance, let's say 15%, you could be making up to 2% monthly return on this. Okay, assuming you did this shorting and leveraging right. So that's fantastic news. Wow, that's great. This is where hedge funds are making a lot of money, right? This is the whole idea behind hedging. You can go short, you can get leverage by shorting a position. And that's exactly the thinking behind hedge funds. Now, if you get it wrong, though, right? If you do it opposite way, if you short Pfizer, which was having a big return, and put the money into Intel, you can lose money really fast too if you go the wrong direction. So that's not so great. Okay, but that's what we're doing in modern finance, where modern finance can slice and dice risk up and pass it off on various things. And it's a big industry doing that. Okay, so empirical portfolio analysis. Okay, what we're going to do is for each month, we're going to compute a portfolio return. It's given some weights. Okay, and then we get the average for the time periods and then the standard deviation. And here's one way of setting up your worksheet if you're interested in doing this, playing around with it. It's kind of simplistic, but it works, which is really great. Again, I like simple stuff. So just set it up like this. Put a couple columns in, put the weights up at top. These are your portfolio weights, right? We're going to have solver pick the weights to do what? Maximize the mean return, which will be over here, subject to a risk. So how do you get that? Well, put the weights up there. Down here, I just computed some summary statistics. Is the mean return is down here. I just do this for plotting. So the mean return for T-bills is B7 to B42. don't really need to do this for Solver, but I just went ahead and did it because we're going to plot some stuff later on. And what's the standard deviation? Well, the standard deviation for T-bills is just B7 to B42, standard deviation .s. Okay. Now here's where you get your month-by-month portfolio returns. We have the weights up at the top, and we use our sum product command, and we put the dollar signs around the weights, right? So it always refers to this with direct addressing. And then we don't put the dollar signs around what was the return for October of 2007. Okay, don't put the dollar signs around that. And so for this portfolio, that puts half of our portfolio into T-bills and half into Apple. For this particular month, October 2007, we would have gotten a 12% return. Okay, so this is like what if? What if we would have done this? This is what you would have gotten, 12% return. And then once you have the sum product set up correctly, you just can copy and paste it to every month in your data set. Okay, very simple. And then from that, you can get the average return of your portfolio. And again, what you're doing there is just taking the average of August 2007 all the way down to, I think it was July 2010. Okay, and that'll be a 1.35% return. So great, even with the recession of the great financial collapse of 2009, we would have still been making a positive return over this time period, which is pretty fantastic, right? That was pretty good for that time period. Okay, and then so that's going to be our objective. We want to maximize that, right? We want to change the weights to maximize the mean return, but then we have a target risk. So I don't want my portfolio risk to be above 7. So this is something I inputted 7. I said, hey, my risk tolerance is 7. Don't go above 7%. And how do I get my portfolio risk? Well, I just take the standard deviation of the monthly return for my portfolio, right? So it's I7 to I42, just a standard deviation down like that. So you don't have to do any complex math with the covariance function and stuff like that, and it works out beautifully. Okay, and a little bit later on in this video, if you know a little bit of matrix algebra, I wrote out some matrix algebra, and you can take a look at it to verify that this kind of spreadsheet setup corresponds to the mathematics behind the mean and variance for the portfolio. Okay, great. It's wonderful stuff. Here's how you could set up in Solver. Again, with you go to Data, Solver. Objective function is the mean. That's I5. By changing the weights B1 through H1, and we have some constraints. I1 is less or equal to K1, so we're enforcing that the sum of the weights is less or equal to 1. This is called self-financing, right? If you let the weight go above 1, it means you're getting money from somebody, right? And you're not really accounting for it. So we want a self-financing portfolio. And then we also have the risk. So I4, that's my risk of my portfolio. My standard deviation of my portfolio has to be less or equal to a target risk, the 7. We want the weights to be positive. We're not going to let any shorting, right? If a weight goes negative, it means you're shorting a position, and then you have extra fees you have to throw in for shorting, and so we want to make them all non-negative. And this is not a linear model. Do not use simplex LP. You just use the GRG nonlinear in Solver, and just as simple as that. And you click Solver, click, and boom, you get this particular solution. So the solution puts a good chunk of our portfolio, 38% of a portfolio goes into Apple, nothing in T-bills, nothing in Amazon, a little bit in Detroit Edison, a little bit in Ford, and a good chunk, 55% in Pfizer. Okay, I just used 1, 2, 3, 4, 5, 6, 7 assets here just to get onto the screen, right? Otherwise, it'd be much bigger. You couldn't see it. And just doing that, we get a monthly return of 1.8%, and we hit our 7% target. right? So we made it all the way up to our target risk, and the sum of the weights is less than or equal to 1, right? This is a pretty simple constraint to satisfy, because if the sum was less than 1, it means you have some money you did not invest, and so of course your mean returns are going to be smaller than what it could have been. Okay, so this is my 7% solution. Apologies to Sherlock Holmes. Okay. Here's just some matrix algebra. And again, if you know matrix algebra, this is really trivial. Okay. If you don't know matrix algebra, you say, I have no idea what you're talking about. One way of thinking about matrix algebra is just bookkeeping. Just makes your algebra simpler. What you think of as a workbook, your data just becomes a symbol, a matrix, and you can do operations on it. And so this is just looking at what would the portfolio return be at time t. Well, it's just the weights times the return of each asset at time t. And you can write that as a vector of weights times a vector of returns for the portfolio. Okay, so z sub t is just a scalar, y t is a vector, the weights is a vector, and I'll just stop there. I'll just pause for a couple seconds on the next couple slides, and you can, if you're interested in looking at closer, you can just, of course, stop the video and take a closer look at it. And so this is just defining some, this is like your data matrix, a big Y. You have n times periods and m assets, okay? You have your weights, you have your z. Some helper vectors in matrix, just a vector of ones, and then the identity matrix, which has ones down the diagonals and zeros on the off diagonals. And from that, you get the mean of y and then the variance of y. This is the variance covariance matrix, right? So this has the correlations in it, standard deviations, all that stuff, all wrapped up into this v of y. And then if you look at the solver model, what we want to do is find the weights to maximize the portfolio mean, z bar, subject to our risk constraint. So v of z is the variance of z, and we want the standard deviation to be less than the target risk. So here's how you can write out what z bar is. Okay, z bar is, of course, just the weights times w bar. Okay, and here's what the variance of z is. So you could write down the solver as W transpose variance covariance matrix of your assets times W. But you can also write it down like this, which is what, as a function of my Y's and W's, right? What we did in solver is what we did here with this middle line. And you can just verify that the two things are equal. And so everything is good. Okay, so let's take a look at what really happens as I change my target risk. Back in the previous slide, I used a target risk of 7%, and now I just varied it from like 1%. This was really tedious, up to 30%, right? So we max out. Our biggest risk was at 4. That went up to, I think, 28%. There's no benefit of going above 30%, okay? But just what happens with your portfolio, I just, reran solver 30 times doing this, got the weights out. And if you're very low risk, like 1%, then you're going to put almost all your investment into T-bills. A little bit into Pfizer, a little bit into Apple, and then some into Detroit Edison. But as you increase your risk tolerance, you put less and less money into T-bills, right? It goes down, the weight goes down. But what goes up? Well, you're putting more money into Pfizer, up to around, I don't know, about 7%. You put more money into Apple, up to around 12, 13%. And of course, what our most risky thing here was Ford. And as you become more and more risk-taking, right, you're putting more and more money into Ford, which was our biggest return for this time period. Of course, this is 2020 hindsight. I'm Captain Hindsight, right? I know what the means and variances and correlations were for this time period. And this is what I would have done, okay, if I had that information. Okay. Now, what's the return? Okay. As I let my risk goes higher and higher, I have a higher and higher risk tolerance, then my portfolio return, right, gets bigger and bigger and bigger. I just trace that out here. Okay. Which corresponds to financial theory, right? The more risk you're willing to take, the higher your reward should be. And that's what's going on here. Way cool. And then you can take a look at, okay, before we did Markowitz portfolio optimization, he did his work, I know, back in the 50s, like 57 or something like that. You would just, look at, well, 10%, we'll just invest in these stocks, we'll get about a 0% return. But after Markowitz, here's where you'd be, right? Instead of down here at 0%, you'd be up here at 2.3%. That is way exciting, right? I got my mean return up so much higher. 2% a month is fantastic, right? On a yearly basis, that's more like 25%, 27%, something like that. Okay, if you could do that year by month for years and years, you'd be a very wealthy person. Okay. And so this black line is just what the optimal portfolio would have given us, right? So I did, again, 5% would be up here, 15% up here. Again, Ford, we max out at Ford, nothing much happens. Apple is the closest to that. And what you notice with this is that this is the efficient frontier, right? So if you saw some of my other videos on linear programming and solver, we talked about what the efficient frontier is. That's when you're using your resources as most effectively as possible. And this is where you'd want to be, is along the efficient frontier. And that's what you would have gotten with these particular stocks, right? Not very many, If you go to something like the New York Stock Exchange, you might have like maybe 5,000 stocks you can play with. But here's what your optimal portfolio would be, your efficient frontier. And we beat most stocks, right? Citibank's a loser. Detroit Edison's a loser. Procter & Gamble's a loser. We're going to invest in them, depending on our risk tolerance, to get up to this top line. And this is why people in finance make $1 million bonuses every year, is by doing this kind of stuff, right? So this is still, even today, pretty much the state of the art. Now, what you do in practice, do they do this? No, they don't do exactly like I did it. They don't use Solver. Solver's in Excel is going to die, but it's a good example. Of course, what you have to worry about a lot is past risk and return may not carry forward. Right? And this is where you have a role for security analysts. Maybe they want to make some adjustments. For example, with Tesla, what should you do with Tesla? Its return's been fantastic. If you put historical returns into your model for Tesla, it will just dominate everything. You just put 100% in Tesla. But going forward in the future, do you think those returns are going to carry forward? I don't know. I don't want any Tesla fanboys getting mad at me. Is it overpriced or underpriced? I don't know. I don't get paid enough for that, right? If I did know, I sure wouldn't be doing a YouTube video. So another aspect is the frequency of sampling asset prices. The example we used monthly, that was a nice compromise. If you use daily, okay, you're going to have a huge variation in return. If you do yearly, you're going to have much less variation in return. The trouble is, if you go farther back, if you use monthly, you have to go farther back. If you use yearly, you have to go farther and back in time. Okay. And then you have to start to ask, well, does data from 10 years ago have anything to do with data today? Stock prices today? Yeah, I don't know. Whereas if you use daily, you have a lot of data, but it's high variation data. Okay. So I would recommend the frequency of sampling. I would say it depends on how frequently you rebalance. If you're rebalancing daily, then do daily data. If you're rebalancing once a month, then do monthly data. If you're only rebalancing once a year, then you're probably losing money. So it's up to you. The length of the data series, usually you want like 60 days or 5 years of data, like maybe 30 to 60 observations. Too short, you get poor estimates. Too long, you got to question how relevant it is when you go back that far in time. A big downside is new firms don't have long data series, right? So recent IPOs would be hard to put into this kind of model. You'd have to do some guesstimates about what you think the mean return would be and what the standard deviation and correlations will be. In practice, you often have other constraints, right? Like often mutual funds will have a constraint such as you can't have more than 2% of your portfolio in any one stock, right? You can't just load up on Tesla because then it's not a mutual fund. That's just holding one stock. And then also lots of mutual funds will diversify across industries, across asset classes, across nations, things like that. Okay. And you can put those additional constraints into your model. It's not hard to do whatsoever. Okay. And yeah. So this is fintech, right? So it combines modern financial theory with some statistical analysis. Or if you come from a computer science department, data science, it uses optimization, okay, little optimization program, lots of IT. Usually when I think of IT, I think of the data flow, right? You have these massive data sets and you have a data flow going into your optimization package. You're doing statistical analysis along the way with means and standard deviations or whatever. And it scales in real time, right? So Harry Markowitz, he did his paper probably used, maybe it took him 6 months to do the analysis in his paper going over this. Now we have real time, right? You have massive 5,000 assets, or if you look at a global basis, maybe 15,000, 20,000 assets that's feeding into your optimization function using daily data, or, you could do hourly data. Wow, huge data sets flowing in. It's all very feasible, they're all very possible. And that's what fintech's doing today, right? And boy, they're making huge sums of money. Okay. Okay, great. Hey, I hope you enjoyed this video. If you did, please give me a thumbs up. Leave some comments. Let me know what you think. If you have some suggestions or some ideas about other videos for business analysis, please post those too. But thanks very much. I hope you got something out. See you later.